you ever wondered why some of the world's smartest investors are quietly moving billions into private credit and debt? While traditional bonds are struggling to keep up with inflation, private credit has become one of the fastest growing and most compelling areas in alternative investing. And here's the kicker: private credit didn't even exist in its current form 20 years ago. It was born out of the financial crisis when banks pulled back on lending, leaving a huge gap. Private funds stepped in to fill it, and they've been growing ever since. Today, we're going to unpack why. Welcome back to Investing Outside the Box, where we look at strategies and opportunities beyond the traditional stock and bond portfolio. I'm David Harris, founder of Alternative Investment Advisors, and today we're diving into private credit and private debt, a space that's exploded in recent years and is now firmly on the radar of high net worth investors and family offices around the world. So what exactly is private credit? At its core, it's loans made directly to companies or projects outside of traditional banks. Think of it this way: instead of owning the bond, you're acting more like the bank. And because you're stepping into that role, you often get higher returns and more control than you would in traditional fixed income.
It's just in its simplest form is private loans to privately owned companies, privately owned real estate, and privately owned infrastructure.
Private credit is growing not just because rates are higher and therefore investors want more of it.
What's interesting about private credit is the money is not funded with bank deposits and leverage from the interbank market. It instead comes from pension funds, endowments and foundations, insurance companies, retail investors, sovereign wealth investors. So it is loans from a source other than deposits, usually to privately held businesses.
So why is private credit getting so much attention today? First, banks have been pulling back. After the 2008 crisis, new regulations made it harder for them to lend, especially to smaller and middle market companies. That created a financing gap, and private credit managers stepped in. Second, interest rates are higher. That means yields in private credit have gone up too. And third, the illiquidity premium. In plain English, investors get rewarded for tying up their capital in less liquid deals. That's why pension funds, endowments, and family offices have poured billions into this space. Now, not all private credit looks the same. There's direct lending, senior secured loans to middle market companies. Next, mezzanine debt, a blend of debt and equity, often with warrants. And then there's distressed debt, buying debt from companies in trouble. And last, specialty finance, real estate loans, equipment financing, or consumer credit. Each has its own role. Each has its own risk-return profile. For high net worth investors, the appeal is clear. Attractive yields, often 8 to 12%, sometimes higher. Many deals are secured by collateral. Returns are not tied to daily stock market swings. And floating rate loans can even adjust for inflation. It's a way to generate consistent cash flow without being chained to equity market volatility. But, and this is important, private credit is not risk-free. These investments are illiquid. You can't just sell them tomorrow like a stock. There's also credit risk. The borrower could default.
The risks in the private credit market are essentially if the floating rate interest causes further degradation of the quality and the health, the financial health of the borrower. If it makes it so that they become unable to not only pay back that interest and pay back their principal, but also just unable to function because they're overwhelmed by those interest payments and overwhelmed by the debt.
PIMCO flagged several risks in the space, most notably its underregulated and transparency lacking nature. Their chief concern: when will regulators start looking? Credit rating agency Moody's only recently created a team dedicated to research and rating of the private credit funds.
This is an opportunity for the private lenders to step in as the bank's going to be faced with higher capital and liquidity rules. And broadly speaking, we are raising the question, is there appropriate governance of risk in these private markets? And I think we can play a role in providing that transparency for investors.
And most importantly, not all private credit funds are equal. Manager selection and independent due diligence are absolutely critical. In my practice, I've reviewed hundreds of sponsors, and the difference between a great manager and an average one can mean the difference between stable returns and real headaches. Let's make this real with a few examples. First, Sirocco Partners. They operate in life settlements. They buy existing life insurance policies, and those policies themselves serve as collateral. The strategy is uncorrelated to the stock market. They target about 12%, but last year they delivered 16%. That's steady income backed by hard assets. Second, Exchange Rate. They offer the essential income REIT. Picture more than 350 properties leased long-term to tenants like grocery stores and pharmacies, businesses people rely on, even in a recession. It's diversified across the country, and historically, it's produced tax-equivalent yields between 9 and 14%. For investors who want stable, real estate-based income, this model checks a lot of boxes. And third, RevTech. They focus on the lower middle market, companies too small for Wall Street, but still needing capital. RevTech steps in with senior term loans, targeting a distributed yield of 12 to 15%. And here's the kicker. They sometimes negotiate equity participation. That means investors can get steady cash flow today, plus a share of the upside if the borrower grows or gets acquired. Together, these three examples highlight just how diverse private credit really is. So let's wrap this up with a few takeaways. Private credit is here to stay. The opportunities are diverse, from conservative to growth-oriented. Manager selection matters more than ever. And private credit should complement your portfolio, not replace it. Private credit is no longer just for big institutions. It's a powerful tool for high net worth investors and family offices looking for yield, diversification, and downside protection. At Alternative Investment Advisors, we analyze every company we offer to clients and then compare that analysis with independent third-party due diligence. Most advisors simply don't have the time to review the dozens of sponsors that we do. And we're not here to replace your advisor. We're here to complement them, bringing deep expertise in the alternative space and helping ensure you have access to the highest quality opportunities. Next week, we'll turn to hedge funds and structured strategies, exploring how creative approaches are being used to generate returns in any market environment. If you found today's discussion valuable, subscribe, share it with someone you think would benefit, and visit altsadvisors.com to schedule a conversation with me directly.